All right. So for the next section of the roundtable, we're going to be talking about something totally different. This is a risk identification project. And let me open up the form that I'm working on and share it with you. There we go. Can everyone see that Excel schedule? Yeah. Okay. So once again, the idea here is that in a lot of the Strength Matters convenings and conversations that we've had with CFOs over the last 10 years, this issue of risk, enterprise risk management and risk identification has been growing. And it's gotten to the point where Strength Matters was recently reaching out to the CFOs on the calls and asking for input on what are some of the risks that each organization has identified. What we're shooting for is a tool that maybe could be put onto the Strength Matters website. And so it's something that everyone, all the members of Strength Matters, could then download and use internally for their own organizations as they try to identify what are the risks that their organization is facing and what can be done to mitigate those risks. I don't know if this form is going to get to that point or not, but it's a form I've been using with clients. And I've gotten input from several CFOs already on this form. And so we're building it, and you know, we kind of like where it's heading. And I'm going to share it with Strength Matters, and they can take whatever they want from it to incorporate into what they put onto their website. But I thought we would walk through today this form and work on it together as like a committee, because it's really, I'm hoping it'll be a tool that will be very useful to all of you. So the idea here is that we have a list of risks, and we've tried to organize it by categories, and you see the tabs at the bottom of this schedule. It might be hard to see, but I'll be going through each tab in a moment. But it's things like financial statement risk, loss of assets kind of risks, non-compliance risks, IT issue risks like cybersecurity type things, insurance issues, HR issues, keeping the pipeline full kind of risks, competition, environmental, legal, regulatory. It goes on. There's like 11 different categories of risks that so far that are on this form. And then on each tab, there are lists of risks that are specific to that particular area. And so what we've done is come up with a kind of a matrix where for each of the risks that you identify, you first identify, is this, how likely is this risk to happen? You know, anywhere from unlikely, happening seldom, happening occasionally, happening pretty likely it's going to happen, or definitely going to happen. This kind of risk is definitely out there. So 1 to 5, kind of a scale there. And then the second question is, what are the consequences of these risks? Everything from insignificant to marginal, moderate, critical, and then catastrophic. So A through E are those grades. So ultimately, the exercise is to first think about what are the risks, and then secondly, try to assess what is the likelihood and the consequence of each of these risks. And then the form will automatically populate this risk rating, which is that next column on the instructions. And so it'll either say it's a low risk, a medium risk, a high risk, or an extreme risk. And we've used some color coding so that it's automatically, we're using conditional formatting in Excel here. So the risk rating automatically pops in, you know, everything from yellow, green, meaning low risk, to very bright red, meaning very high or extreme risk. And so you can see at a glance which are the risks that are the most significant to be addressed first. And then we have a column you'll see where we identify what are the current mitigations in place that are already helping to address these risks. And then finally, what efforts are needed in the future to mitigate risks in the future. And then we try to rank those between high efforts that requiring a lot of coordinated effort in multiple departments, or medium, or low. So let me go on to show you how that looks in a second here. But before I go on to the next tab, the best practice was something that came up at a recent board meeting. I was presenting this to an audit committee of one of our affordable housing developer clients, and they came up with a pretty good idea, which was the audit committee felt like it was their job to really oversee this whole process of risk assessment. But they thought that it would be best to allocate responsibility for the different tabs to other individuals who know more about each area than necessarily finance, which is more focused on financial statements and maybe some of the loss of assets items. So they were going to involve HR and IT and other departments, development, to each take responsibility for one of these tabs in the Excel schedule and populate it with the risks that their area of interest is facing, as well as the current mitigations and what needs to be done, and even to evaluate the significance of each risk. And then come back at a future board meeting and present this to the audit committee as it progresses, probably over a series of quarters for the next year or so. And hopefully, having done that, move a little bit closer to mitigating the most significant risks, and at least have a feeling that the organization is approaching all of this in a organized and logical way. So that's really the goal of this tool. Here's this matrix I was talking about, the color codes. So, if it's a risk that you've deemed to be unlikely and insignificant, it's probably going to have a little green box. On the extreme other hand, if it's a definite risk and it's very catastrophic, then it's going to be a red box. So these colors, you'll see green, kind of a tan, a pink, and a red in kind of increasing levels of heat, depending on how important the risks are. So those first two tabs on this tool are just explanatory. Now we get into the actual risk form. So this first one is basically just focusing on financial statement risk. I started with that because I'm an auditor, so those are the risks that I'm the most concerned about, and the ones that we try to address when we do audits, because we don't want to have a misstated financial statement. I tried to break it down into areas that made sense, like cash, receivables, prepaids, fixed assets. So it goes through the balance sheet and the income statement in kind of order, the normal order. And I just started by writing down a few risks that top of mind kind of a thing. But like for cash, there's a risk that the bank reconciliations are erroneous and there's items missing from the bank reconciliation, so the cash is misstated. With multiple entities, you've always got a risk of applying cash to the wrong entity. So you haven't really lost money, but it's just misstating the financial statements of that particular entity. In receivables, you've got misstatements due to inadequate allowances for uncollectible accounts. You've got omissions of contribution recognition. We were talking earlier about at what point should we accrue the contribution for the forgiveness of the PPP loan. So there's always a risk that we're going to put the revenue in the wrong period. We also have premature revenue recognition risk, where we recognize income before it's earned or before it's been forgiven. Diverting tenant rent from one unit to another just to prevent eviction. We've seen this happen in properties where property, if back when they were receiving cash on site, they might be manipulating whose account they're putting the rents to. So anyway, I won't read all of the risks, but the idea is with each of these, I put in a likelihood. A lot of these are kind of moderate. They might happen. I've seen them happen, so they're not definitely going to happen, but they could happen. Some are more likely than others. This one about manipulating the rents from one to another, I said was kind of less likely. I made that a 2, but understating your reserve allowance, I made a 4 because that's pretty likely to happen because that happens a lot. Here's a 5, not accruing costs in the proper period. Now we're talking about payables and just doing an adequate search to make sure you've got all your payables booked in the right period before you close your books. That's pretty definitely going to happen unless there's some kind of mitigation in place. So I made that a 5. The idea of this tool is that each organization would fill it out for themselves. You're not just following whatever I said in terms of my likelihood assessment. It's a tool that's, you can customize it and put in your own likelihoods and add more risks. And I'm hoping we will add more risks after I finish explaining how it works. The consequence, you know, anywhere from A here is not too important, and that was the maintaining inaccurate fixed asset and depreciation records. I would imagine that most of the replacements, I'm not thinking about cost certifications now, I'm thinking about as the property ages and assets are replaced, and you know, sometimes they're expensed or sometimes they're capitalized. The consequence of making them wrong judgment there, probably not too significant, because whatever you're replacing is probably going to have to be written off anyway, and it might end up being a similar expense to the original cost of the replacement item. So I made that an A, but here's an E, which is the most extreme consequence, and that was increasing depreciable basis by including unqualified costs or ineligible costs. I'm thinking about tax credits now, and putting something into the fixed assets that really is not capitalizable and having it end up in your eligible basis and getting tax credits on it, and then finding out later on that it's not eligible at all. Like a land cost ended up in building for some reason. Nobody caught it, and now you've taken credits on it, and you have to recapture those credits when somebody discovers that, if the IRS is aware of that. So made that an E, which is the most extreme result of a financial statement misstatement. So yeah, let me just show you now if the likelihood of that was a 2. I made it a 2 because you are in fact having cost certifications, and so hopefully the auditors are catching those types of things, unless they're extremely immaterial, in which case then it may not be that devastating if it happened because it was immaterial in the first place. But if we decided the likelihood was a 5 instead of a 2, you see how the cell became red now, because it's now a high risk, because it's a devastating impact and it's very likely to happen. So that's the importance of the likelihood and the consequence. If I decided the consequence was not E, but instead kind of a minor consequence, if I made it a 5, so highly likely, but the consequence is B, we didn't go red. It wasn't until the consequence, what, becomes a D probably? Yeah. So a D consequence, it becomes now red. So that's how the form works. Then over to the next column. This is where it's kind of a free form space where you can write in, well, we already have these situations. We have all of our intercompany fees are supported by agreements. So based on that, we shouldn't really have, this is on the propriety of fees charged to affiliates. We shouldn't have that situation. So we already have a mitigation, and but maybe nobody's looking at the agreement when they're accruing the fee, so that's still a risk. And then you could, in the next column, which is the actions and amount of effort needed, this is where you're saying, okay, this is what we need to improve. We saw that there's a risk, it's pretty significant, we want to address it. Or maybe it's just moderately significant, but we still want to address it. And this is what it would take. On one of them, it was not recording contributions. And so the suggested action was, let's match our fundraising records from our development department. You know, they're using software to track contributions. Let's try and match that to our accounting records just to make sure we've captured everything that development thinks that we received this year in terms of contributions. Another one had to do with the property management. Maybe the site manager was collecting rents and manipulating them. So the action needed was to centralize collections back at the central office of the property management company rather than having them going on at the sites. Though that one in particular was seen as a kind of a high effort one, because now we need to involve multiple departments. It's going to take more than just a few days to make that change. But the one about matching the fundraising records, that's kind of a low effort. That's just asking for the report and giving it to whoever's in the accounting department and in charge of the contribution revenue and say, do these numbers reconcile and why not? So anyway, I think you get the idea of how the form is designed. And before we turn it open to getting input from everyone and how to improve it, let me just show you the different tabs. So the first one, like I said, was financial statement misstatements. The next one is loss of assets. So these are all items that could happen that are actually going to that will result in losing usually cash, but it could be losing other assets as well as cash. But a lot of embezzlement. So I grouped these risks in the areas of embezzlement. There's like 29 of those risks. Again, a big focus of auditing is kind of trying to look for some of this type of thing. Then on the new developments, we have a potential loss of assets when it comes to spending too much money on properties that don't end up going anywhere. During pre-development, they're abandoned. And other new development risks like that. Unforeseen obstacles in the development process that leads to loss of the developer fee. I've seen that happen many times. Operating projects, we get into some losses when it comes to unanticipated vacancy levels, loss of uninsured cash over the FDIC limit, funding operating losses in properties that are just always in a deficit position, investment risk, and litigation risk. So anyway, all of that is loss of assets kind of risks. The next tab is compliance, regulatory non-compliance. I identified a few agencies that we're all concerned about, making sure we comply with IRS regulations, violating tax-exempt status risks, tax credit risks, not qualifying tenants moving in at move-in, losing some credits there. Department of Labor risks, thinking about the 5500s if you have more than 100 participants, not having the audit or not having a proper summary annual report, lender risks, debt covenants in particular, donor risks, misspending their contributions when they were restricted, federal being one part of that risk, which is not following the uniform guidance requirements for the federal funding. And then there's other agencies, Department of Real Estate. Here in California, we have a DRE compliance that we're concerned about. And basically, reserve withdrawals, approvals, affordability levels that our local governments have been imposing based on how they have passed through, for example, funding and applied additional deeper affordability levels. So we want to comply with all of that. Some of these areas are not my specialty, so I didn't have a huge long list of risks, but IT, data security, email, cyber attacks, keeping up with software, new to be efficient, new developments in software, insurance.
I can speak to the IT, as we were unfortunately a victim of a cyber attack earlier this year, and are just getting ready to today send out all the notifications. There's about 300 plus employees, residents, and business partners whose personal information was potentially compromised. So it's a real risk, and it's quite an time-intensive process. And thankfully, we had cyber insurance, so that is a big mitigating factor, and as well as now some of the additional security we put in place.
Yeah, the risks are out there, and even our firm has lately hired a independent service that part of the process is they've been sending phony phishing emails to our staff unannounced just to see who would click on them. And if you click on one of these phony phishing emails that you've been lured into a trap, then you get a email back from from our entity that we're contracting with to help us get better at this. And when we started the process, something like, I don't know, 1/3 of the staff fell victim to the phishing email. So anyway, they provide training videos, and so there's websites that, if you fail the test and you fall victim to it, you're then encouraged to take one of these training videos. But now with the COVID lockdown and everybody working from home, almost everyone other than Kathy there, working from home, we have a lot more risk because we have a lot of people using laptops that were never even vetted by our IT department. So we're using, you know, unapproved hardware and getting in and using our phones to do our work. And so all kinds of things are happening. So there's a lot more risk now even than before March. So I'm hoping that you're all, as you're listening to me, you're not just falling asleep, but trying to take some notes about some of the topics that you want to circle back to, because we will have about 10 or 15 minutes, maybe 20 minutes at the end before our time is up to try to make this better. So anyway, insurance was the next one. You know, earthquake, a lot of people are not bothering here in California, cannot afford earthquake insurance. So we're going bare when it comes to earthquake and just hoping that it never happens. But we know it will happen eventually. We're just hoping it's not a devastating one that's going to knock out our properties. I do have a client that had not an earthquake, but a fire damage a year ago that eliminated the entire development. So the entire project, the tax credit property, the entire property was burnt down to the ground, unfortunately. And the consequences of a loss like that are just incalculable and devastating, not only to the families, but to the developer who now has to rebuild and decide how to, you know, deal with the tax credits and the investor and all of those issues.
For us in certain areas, well, in Sacramento, you know, flood is also a big concern because there's a lot of, you know, we have two major rivers and a lot of creeks and tributaries that run through the area, and we're kind of, you know, rolling the dice the same way where we don't always put flood insurance on all the properties unless it's specifically required by one of the lenders.
All right, good one. I added it. HR, non-compliance with the HR regulations, employment practice litigation risks. Julie, you added this one, FFCRA non-compliance. Was that because of anything in particular that happened or concern that you had?
Yeah, we did, not that we were not complying, but that under the CARES Act, that was a new leave benefit that was made available to staff around April. And we had, unfortunately, someone who had indicated to the department later that we were not complying with it. And so about the end of May, they really were quite quick in contacting us and then reviewing with us whether or not we did comply, and it was concluded that we did. But it was a risk that we didn't even really realize was out there until we got the notice from the Department of Labor.
All right. And then there's just termination risk, employee satisfaction risk that you'll lose dissatisfied people that you need to keep. And it's the problems with replacing them creates a risk that you don't want to face. We have one on pipeline risk, keeping the pipeline full, make sure that there's enough projects in development in the development pipeline to make sure that you're going to keep your project management staff busy enough. You have a certain number of people that are just focused on project development, and how many properties do you need to keep them adequately entertained, so to speak. So keeping the pipeline full, but not so full that you're overwhelmed with so many things and running in too many different directions that you're pulled in a way that you can't sustain it. So, but the part of the pipeline risk is also building costs keep rising, and it's becoming harder and harder to, you know, here in California in particular, to continue to provide new housing as costs keep escalating.
And I think another thing in the development area is also, you know, maybe acquiring land or holding on, having long land holding periods before you actually start your development, because then it makes it much more challenging to finance your project if you're also trying to include all those holding costs. And it's just, we have that for one of the projects that we're closing on, and in a future closing where I think we've held the land for about 10 years and it was financed with debt.
And so I just typed that in. I don't know, there could be different reasons why you would be holding the land without starting the development. Trying to arrange financing probably is the main reason. But yeah, I've seen some properties where 10 years goes by from when the land is acquired until when groundbreaking occurs, and the land is just sitting there waiting for the perfect opportunity. And yeah, it is incurring costs during that entire 10 years. Okay, let me get through the rest of the tabs and then we'll circle back and we'll ask for input from everyone. Next one is environmental, obtaining land with environmental hazards, which will lead to high remediation costs, maybe unanticipated high remediation costs. Natural disasters, more and more environmental disasters seem to be happening as our weather is changing. We're getting more of these fires, at least here in California, more fires, and elsewhere maybe more severe storms and tornadoes and hurricanes. So that has an impact, the environment. Asbestos in buildings leading to tenant safety issues, as well as remediation costs. Those are just a few environmental risks that I'm sure somebody who specializes in environmental can be much more complete in filling that list out. And then we have economic and political factors, things like changes in regulations that adversely impact the industry, relationships with the local politicians that are doling out the dollars, overdependence on one product business line, HUD funding availability in the future, economic fluctuations, poor integration of new properties, thereby harming the organization's reputation. So bringing on too many properties too soon, maybe in a part of the state or wherever your office is, a new area where you don't necessarily have a lot of experience with that. Tenant population are some of the local issues, and it might be harmful to ultimately to the reputation of the organization. Changes in laws.
Construction materials one, I just want to comment. I think that's, we're hearing a lot about that from our general contractors. The lumber prices are probably close to an all-time high, and then the availability of concrete is potentially impacting the timing of our projects.
Mm-hmm. Yeah, I'm sure the coronavirus thing didn't help with the cost of materials and the availability of materials, and it has led, from what I understand, to construction slowdowns. Leadership, just being able to adequately identify effective leaders as vacancies arise in your organization. You know, where do you go for your next executive director or your next CFO? Providing enough training to enable advancement, and identifying backup, and even board involvement. And sometimes the board can send mixed signals to management, and so the direction of the organization can get somewhat muddied because some people on the board want it to go in this direction and others go elsewhere. So anyway, I think you've got the idea now of what I'm trying to do. Oh, here's another one: competition, competitive forces. I think this is the last one. Losing potential development opportunities to other qualified developers. You know, it's a competitive area. You know, here in Northern California, we have a lot of similar, we're happy because almost all of our clients, but we have a lot of similar nonprofit affordable housing developers out there. And you know, to some extent, you are competing against each other for similar developments in similar locations. And that might have something to do with the gap financing available from governmental agencies. You know, just because other organizations are draining some of that money for their needs, and so it's not left for you anymore. Okay, so I think I've gone through all 11 of the tabs, and what I'd like to do now is ask you all to unmute yourself when you're ready to say something, but I'd like to hear if there are missing tabs, if there's some area you think we should add to this tool, and if not, or at least on the tabs that exist, what kind of risks do you think we should have listed that we haven't already listed? Julie's been giving a few suggestions all along, so I've been trying to take notes and update this as we go. But
Looks like someone unmuted themselves.
Okay, Brian?
This is Brian. This kind of goes back to what you said at the outset. It'd be good to have a heading or a column that indicates like which department or which individual would be responsible for that particular risk mitigation. And then also it was a little unclear if it's, or maybe a feature could be added that identifies which are the next steps. Maybe a lot of these categories, all the mitigations are in place and there's nothing further to do, just keep business as usual, and then there somehow be an identification of which efforts are needed immediately or in the near term or in the future.
Yeah, those are great suggestions. I'll incorporate that. You know, I guess the question is, how far should this tool be? Is it the end all and be all of the whole process, or is it just a roadmap? And then, you know, each of these risks will eventually get dealt with on some other format. And this is just a way of summarizing what's going on. But I will add that responsible individual and next steps thing.
Art, did you have a comment?
Yeah, I did. It's Art Fadum. And first of all, on behalf of Strength Matters, I want to thank you for not only bringing this discussion up and getting some further input, but also offering to be part of the what ends up on the Strength Matters website. We will put something up and make it available to people. There's a chance we'll get a grant to create some curriculum around enterprise risk management, but that's a next year thing. But this tool of yours, Scott, is excellent. I think it summarizes things well. I like the idea of the responsible individual and probably another column on sort of the status. Is it done? Is it in process? Is it not yet started? Something. So I think your point a second ago, is this the be all and end all? Probably not, but there's certainly a worksheet to go back to check and update what progress is being made and who's doing what as you go along. So anyway, thanks again for taking the lead on this.
Yeah, it's been my pleasure. You know, this is a tool that I've been showing to clients selectively over the years. It's usually only when the audit committee says, you know, they start to read their charter, the audit committee charter, or they read something on the AICPA website that talks about what audit committees are supposed to be doing. And so they see, oh, in addition to, you know, retaining the auditor and approving the financial statement audit and having an exit conference and an entrance conference about the audit and maybe looking at the tax return, in addition to all of that stuff, apparently they see audit committees are also recommended to be considering what are the risks facing their organization and satisfying themselves as audit committee members that the organization has adequately addressed those risks. And so once in a while, not often, but once in a while, an audit committee will go in that direction with me during the exit conference for the audit, and we'll talk about having a series of sessions throughout the rest of the year, because usually the audit's done in the first part of the year. We got the rest of the year to have more meetings if we want to, and so in the rest of the year, we talk about this kind of thing, and this is a tool that I was showing them for that kind of a conversation. But since the Strength Matters push came up in the last couple of months, I've spent a lot more time thinking about how to make the tool more workable and useful. And so that's how it's really developed. And thanks to all the CFOs like Julie and other CFOs that have given me input on this. Karen, I know, is on the call today. Karen also helped with this one. So yeah, thanks to all of you for making it what it's become. And I'm hoping it's going to get better. And we have 9 more minutes to try and do that. Any other thoughts about ways to improve this? And while you're thinking about that question, I guess maybe the big question hidden in all of this is, do you see a tool like this being useful in your organization? Has there been discussion about risks at the board level or at the management level? And do you already have something that does something pretty similar to this form, or is this form actually something that you would want to use, we can make it available. Even though it's still in a beta format, you could start using it for what it is, for what it's worth.
Yeah, we have a comment in the chat box from Tammy who said she'd love to see this on the Strength Matters website. Sounds like she just updated her membership, so that's great.
Wow. Bringing in membership renewals just because of this form, that's great.
Scott, it's Art again. I'm committed to getting this up prior to the conference at the end of October, so that we're going to have a session on ERM at the conference and want to be able to refer to the tool being available to members. So thanks, Tammy. Appreciate
that. Anyone else? Don't have to use the chat. You can actually unmute yourself and speak up. Interested to hear how you might use a tool like this in your organization. Do you like the idea of having the audit committee and the board assigning responsibility to different departments, or would you do it strictly with management? Or kind of curious how you would choose to implement it.
I can speak for our organization. We have just started talking about using this type of tool. I could see us doing it more at the management and executive team level with some board participation and sharing it with the board. Our board is a little unique in that more than half of the board is made up of resident board members. And so I could see where us as the management and executive team working to identify risks and getting input from the board would be a process that would work for us.
Yes, some of the things I've heard in discussing this with other CFOs is, first of all, the issue comes up. The board may not know enough about the organization really to adequately complete this form. So maybe the board is, not involved in the day-to-day, obviously. And so they're going to rely on management to a great extent to complete this on their behalf. But still, the audit committees can monitor progress, as I suggested, by looking at the form maybe every month or every quarter, just to see what's moving along. And so that's one comment. Another comment I got was one CFO said, their board has talked about documenting the risks and doing an exercise like this, but they were always reluctant to do that because there was a fear that once you start writing down risks, then you will be accused if you omitted something later on. Somebody will say, why didn't you think of this risk? And so they never wanted to get very, never wanted to document the risk assessment process. They could have conversations, but they never wanted to write down very much because they didn't want to have anyone second guessing those risk assessments. So when that CFO was presented with this idea of having maybe Strength Matters or maybe somewhere else, a form like this that they could use, that CFO thought, wow, that really solves my problem, because now somebody else has identified all the risks that we should at least start by thinking about, and we won't be accused of having omitted something obvious, because we're going to start with something that the whole industry has blessed as being a pretty inclusive list of risks. So that was some interesting feedback.
I have another comment in the chat from Margine, and she says it seems like a great tool for boards of all nonprofits. I think boards of small organizations struggle to understand what risks they should be looking at and addressing exactly what responsibilities they have in terms of risk assessment in relation to their audit, which I agree is a challenge.
Yeah, I agree. I think that's been my experience. Often when I ask audit committees, what are the risks that keep you up at night? We don't get this granular. All of the risks that are on this form, almost none of them get mentioned. They're much more high level, 30,000 foot level, because again, I don't think because they're not focused on the day-to-day risks that you're really facing every day, they're probably not likely to concern themselves. They would if they saw them all on the form. So that's what's nice about the form. Now they have a lot more to worry about.
Two things. This is Art again. When I was at MidPenn, we went through an exercise like this, and causing me to lose my voice apparently. Excuse me. We did it internally, much as what Julie was just talking about, is did it through the executive team, with each executive team member owning their area of responsibility with the CFO coordinating it. We reviewed at a very high level with the board, and they were satisfied with that. I'm on the board of a CDFI that's also going through risk assessment and using an outside firm to help identify various risks, and we're reviewing that with the board. Not in as much detail as this tool has, because this is very comprehensive and some items that probably shouldn't go to the board, but nobody should worry about. And we're reviewing it quarterly in terms of the progress that's being made. We haven't seen the output yet, so I don't know how that's going to get followed up going forward, but I do see this as coming up a lot more frequently, ERM generally.
And there's another item in the chat from Kathy. It's the one I think we all missed, and is could anyone have predicted the risk we're currently living through with this pandemic? So I don't think any of us saw that coming.
Yeah.
So there are risks that are hard to identify.
Yeah. Sometimes when you think about, so specific to MidPen, because we're based in California, we had, as part of our risk assessment, thought through what happens if we can't get in the office. Earthquake, fire, something that we're locked out of our office for a long period of time. Had nothing to do with the pandemic, but helped start thinking about remote work and things like that. So, and somebody just popped up the same thing. Jonathan.
Yeah.
But I think sometimes if you've thought through what you can know, it helps you with what you can't know.
As horrible as the pandemic is, I'm just grateful that it's happening in 2020. Imagine if it was happening in 1999, we wouldn't be anywhere near as well equipped to work from home and do all of this. So the timing was better. I feel bad about the 1918 pandemic. They didn't have any of this working from home ability, and most of the labor in those days was probably manual labor and no way to do it working from home for the most part. So we're in a much better environment for this now than we would have been previously. So I'm grateful for that.
Yeah, and we had Jonathan who mentioned that those who had disaster plans in place when their office was closed were probably better able to react when we had to start working from home.
I see we're at the end of our 2 hours now. Those of you who are CPAs and want CPE credit for this, please email me. My email address is my first initial S, my last name Seamands, S-E-A-M-A-N-D-S. Sorry, I don't have this on a slide, but it's sseamands@lvhj.com, or just go into our website and you'll see my bio there, and my email is, our website is lvhj.com for Lindquist von Husen Joyce. So I appreciate all of your attention and your input on this, and hope to see you all at the next quarterly roundtable, probably maybe December, January timeframe. And stay safe, everyone. And thank you very much.
Thanks, Scott.
Thanks, Scott.
And Julie, too.
Bye, everybody.
You guys, bye-bye.
Bye-bye.